Hey there, and thank you for downloading our investment calculator. This is just going to be a quick tutorial on how best to use it. But before we get started, a quick disclaimer. This calculator is for informational purposes only and should not be considered individual investment, financial, or tax advice. And as always, for personalized advice, please make sure you consult a qualified financial professional. All right, so jumping right into it, investment calculator is just a simple calculator that takes investment assumptions that you plug into it and gives you the future value of what the investment is going to be worth based on those assumptions. And so for this calculator, we kept it pretty simple here with 5 pieces of data that you need to enter in, and then the calculator does all the rest of the work for you. And so we'll go through those step by step so you can get the best use out of this. But at the end of the day, this calculator would be used for something like, hey, I'm just starting out investing. I want to see if I put $500 away in an investment every single month for 30 years at 10%, what would that be worth 30 years from now? And then that's what this number is here. It spits out this number. We'll talk about some of the graphics over here and this investment growth projection table as we get going. But starting with the very first piece of data that you need to enter, which is your initial investment. And just like it sounds, this is the money that you already have in the investment or that you're gonna put in there on day one or the first day that you make your initial investment, okay? So this could be 0 if you're just starting off in your investment journey. This could be 0 if you're just trying to run this calculator to see what a potential investment would be like. Or this could be $1 million. You're starting off with $1 million already in your brokerage account and you want to see if you add $5,000 a month to it for the next 10 years, what that would equal 10 years from now. That type of thing. So this is going to range wildly different for everybody. For instance, let's say you're getting an inheritance right now of $100,000 and you want to see what that would look like if you don't contribute anything more to it, but you put it into an investment that's going to yield you 7% for the next 15, 20 years, whatever. You could put $100,000 in there, put the rest of the data in there that we're going to talk about, and it'll spit out what that is going to be worth or valued X amount of years from now. So that's kind of the way that you would use this and how you would decide what to put in there for your initial investment. So again, could be 0, could be $1 million, $5 million, $10 million, or anything in between. The next one, probably the hardest one for people to get right here, and you might want to play around with this a little bit, but this is your average annual rate of return. And the reason why this is so important is because the longer the timeline, the more of an impact this rate of return is going to have on your future value of your investment. So it'll sway the numbers a lot back and forth, right? It moves that needle a lot. So people have a tendency to either be way too aggressive and assume that they're going to get a way higher rate of return than what they probably will, or they're way too passive and don't put a high enough number here, and so the investment doesn't look like it's worth taking on, things like that. So just be careful here. I'll give you a couple general historical points here so that you can, if you're new to investing, you have an idea of maybe the number that you should put in here. But this is not individual financial advice or any type of guarantee or prediction on what the return should be. You need to make that decision on your own. And again, you can play with it to kind of see. But historically, if you were in an all stock portfolio, meaning you only invested in equities, i.e. stocks, you would have an average rate of return of somewhere just south of 10%, like 9.8, something else like that. If it was all bonds, right, a little bit more of a conservative investment, less volatility, you would have an average rate of return long-term somewhere around 4.5-ish, somewhere in there. If you had a blended rate, obviously it would be maybe 5, 5.5 to 7.5, 8, somewhere in there, or anywhere in between. So you have to use your best judgment on here. Obviously, if you have an investment that you're making, like in a CD that has a fixed interest rate, that would be easy to decide what to put in there. But if you're doing traditional investments in stock and bond portfolios or something, use your best judgment here. This document moves. It's a live document, so it moves when you move. So after you get your original calculations in here, if you wanted to see if you were to get a little bit more aggressive and have a higher rate of return, you can just change that number and it will change everything below. So keep that in mind as we're going through this. The next piece of data that you need to enter is the amount of years to invest. And so this is really important, again, because of compounding. You should have this number because you're going to know how long until retirement or how long you want to keep that investment in place or how long that CD is for. So it's a little bit easier number to come up with, but it's very important. The longer it goes, obviously, the more time you have to compound, the higher that future value is going to be. So you'll see here right now at this calculation, this example that I'm using, at 30 years, it's 1.13 million. Okay, if we go just 5 more years of doing the same investment plan, same annual rate of return, it goes up to 1.9 million essentially, which is a huge growth in those later years due to compounding, like I said before. So I'm gonna move this back to 30 real quick so we can keep our example. The last 2 pieces of data here are for if you're not just putting in a lump sum and letting it grow for X amount of time. It's for if you're starting with 0 or lump sum or whatever, but then you're going to continue to add on to it every single month or every single year or bi-weekly on your paycheck or quarterly on your bonuses or whatever your scenario is. This is a drop down right here so that you can see I've already filled in kind of the different ways that you could be investing, the different frequencies that you would be contributing to this investment. And so for our example, I just used monthly. I think a lot of people do monthly contributions to a lot of stuff, but you could use bi-weekly, weekly, whatever, and the calculator will work for you. And finally, the contribution amount. This is your ongoing contribution. So if you're just putting $100,000 in and you're leaving it and you're not contributing anything more, you need to make sure this is 0. But if you're continuing to contribute, let's say to a retirement plan, in an IRA or a traditional brokerage account or an HSA or whatever the scenario that you have is, then you would put that contribution amount here. So for our example, I put $500 a month. We're going to contribute for 30 years. We're going to be very aggressive here and assume an all stock portfolio and assume that it's going to stay somewhere around its historical average over the long term of 10%. And that's it. Everything else is done for you in this calculator. So that's all you need for data input here, data entry, and then the calculator spits out the rest. We're going to take some time here now, going through an example and checking out some of these other parts of the calculator and the spreadsheet that I think you'll find interesting. So right here is your investment breakdown. And all this is showing you and all this is telling you is the blue here is your total contribution. So meaning the cash that you came out of pocket for and you contributed to your individual investment here, okay? So that represents whatever your initial investment was plus whatever your additional contribution amounts were. And that total is 180 in this example that I used right here, right? And what you can see, which is incredible, which is very visual, is 950,000 out of this future value of your investment of 1.13 million came from, it says total interest earned here, but this is your investment returns, right? This is how hard your money worked for you. So you put $180,000 in, and that $180,000 worked so hard for you that it created another $950,000, almost $1 million in this 30-year time frame by contributing that $500 a month. So you can see the power of compounding, the power of staying consistent over time and investing, okay? Next, we have our investment growth projection table down here. One thing to note for this right here is this represents a constant rate of return of whatever you put up here. So in other words, this is assuming you're going to get exactly 10% return every single year for these 30 years, okay? So if you're invested in traditional investments like stocks and bonds in the market and the portfolio, that isn't realistic of how the returns are going to look every single year. So in other words, year 1, it might be negative 5%. Year 2, it might be 20%, yada, yada, yada. And then by the end of 30 years, the average return overall per year was 10%. However, this gives you a pretty good idea of what your investments are going to look like as they track through this, this time horizon that you put of 30 years. So again, just remember that every year, unless you have a fixed rate of return here in something like a CD or something like that, this is going to be, these aren't going to be exact numbers, so to speak. But if you average over 10 or average 10% for that time period, it's somewhat accurate and close. I hope that makes sense to everybody. So anyway, that's the investment calculator in a nutshell. That's how you use it. You can get in here and play around and say, okay, I really want, $2 million for retirement, and I'm 25 years out, and I want $2 million just in this account, regardless of the rest of my investments. So what do I need to do here? You can go in here and you can start playing with this. You can say, okay, I have 25 years. That's all I have until I retire. And now you look, you see, okay, if I'm only doing 500 a month, it'll be 663,000, rough estimate based on 10% return. So let's say, all right, I don't believe I'm really going to get 10%. I think it's probably more like 8. Now that takes us down to 475. If I really wanted 2 million in there, I need to really start playing with what I'm going to start contributing. If I contribute 1,500, I'm closer to 1.5. If I do 1,750 a month, I'm still not there. 2,000 a month, now I'm getting close. And so you can kind of start playing with those numbers and say, well, maybe I think I'll get 9%. Just be careful when you start playing with these numbers, though. Again, you don't want to be too aggressive here, but at the same time, you don't want to be too passive. Say I'm going to have an all-stock portfolio and only put 4% or something in here because that's just not historically what it's provided. Okay, but as you can see, you kind of get the gist of how to play with this calculator and make the most use out of it. I will say one more thing. Not to confuse everybody or anything else like that, but the one other piece of this to just be concerned with is just the annual rate of return. This is the nominal rate of return that you're talking about, and the future value, the nominal value of the future value of your investment. So this isn't the real return. The real return would be the average rate of return minus the inflation rate for that 30-year period. And so if you wanted to find out what the value of your investment 30 years from now would be worth in today's dollars, in other words, what your purchasing power would be worth, you would have to subtract the inflation rate that you predict for the next 30 years from this number to get an accurate number. So to give you an idea, the average inflation rate, depending on what data you use, has been somewhere between 2% and 3% for the last 100 years. So you'd want to go in here and subtract 2 or 3% from this to say, hey, I'm going to take 7% return because that's going to be my real rate of return. And so now, 30 years from now, my money, that the value of that investment would really be worth $609,000 in today's dollars. In other words, my purchasing power would be the equivalent in 30 years to what $609,000 would purchase today. So not trying to confuse everybody, but I just wanted to make sure I added that in here so that everybody can kind of understand that. That's a little bit more advanced, planning and things like that, but I wanted to make sure everybody was aware. So anyway, this is how you use the investment calculator. I hope it helps. Play around with it, download it, share it with a friend. You can save this calculator 5, 10, 15 times so that you can see and compare different investments, different ideas. But this is a live document, and have fun with it. All right, take care.